Hey, my name is Spencer Carenti. I'm with Alkaline Advisors, and today we'll be going over our commercial acquisitions financial model template. So, this is what we call one of our premium financial models. I'll give you a high level overview first, and then we'll dive into the nitty gritty. Hopefully, this takes about 20 minutes or so, and let's begin. So these are fully dynamic models, meaning that you'll see we have blue tabs down here, and then on the blue tabs, we'll have blue cells. Once you update the information into the blue cells, the rest of the model will auto populate and will run accordingly. So to start, we have a cover page. You can paste a picture in here. This entire model prints out nicely into a PDF format. So if we do PDF, and for instance, we do entire workbook, you could see what that looks like in PDF format. So you can print and then send directly to some counterparts. Okay, so we'll start with the inputs tab. The inputs tab is where a majority of the inputs are housed, as you might have guessed. So you'll see over here, we've got at the very top some return metrics. We've got property level returns and then partnership level returns. This is segmented into unlevered returns and levered returns, so that's no debt and then debt. And then partnership level returns, we have the GP returns and the LP returns. So these will update automatically when we change any of the inputs, and you can see how that works accordingly. So we have some general inputs and assumptions to start down below. As you can see, general inputs and information. We have some project timing. As I said before, all of the black text with the white background, that'll update automatically. You just are responsible for updating the blue text with the blue background. So for the acquisition valuation, you can see how are we valuing the asset at purchase. We can choose to buy the asset for a price that's derived from a cap rate, a going in cap. You can choose what year we're capping. We can cap in place, year one, year two, stabilized, right? And that'll all update the valuation accordingly. We can then choose, instead of direct cap, if we want to buy with a straight purchase price or a purchase price per square foot. So then you can add closing costs, other fees, and then a working capital bucket. Then we'll have the capital expenditure section. So this is where, if this, let's say, is a value add project, you can add in some project level CapEx, whatever that is going to cost, and then the start month of when you're going to start incurring that cost, and then the end month. And then what we do in this model is we'll just straight line that cost from month X to month Y. Now we can customize anything, so if there are specific nuances in which you want us to outline in the model, just let us know, and we're happy to do so. Then we can choose what the value of the asset is at stabilization. This is more just for illustrative purposes. And then we have the value of the asset at sale. So are we taking the trailing 12 NOI, the trailing 3 NOI, or the forward 12 NOI? What cap rate are we attributing to the sale? And then what are the selling costs? So that's really the general information. Underneath that, we have operating inputs. So the operating inputs are really separated into kind of two sections. This is general operating inputs on the inputs tab. And then we'll get into this next tab in a moment, but we have the rent roll. So this is where each tenant specific input will be housed for the leases and whatnot. And this is not just revenues, but also expenses and expense recoveries, so to speak. The expenses themselves are on the inputs tab, but the recoveries are on this rent roll tab. So to go back to the inputs tab, we will first talk about other income, reimbursable expenses, and then non-reimbursable expenses. They're set up very similarly. You can choose how they're allocated. So are we allocating the cost to total square footage or just the occupied square footage, right? And then you can choose the income type. Is it going to be based off of rentable square foot per year or just a total amount per year? If it's a total amount per year, you can really almost disregard this cell and this column as it lines up to that. But if we wanted to do, for instance, rentable square foot per year, then everything changes. So we can say it's going to be signage income, let's say $25 per rentable square foot per year based off of the occupied rentable square footage. If we wanted to do based off of the total square footage, you'll see how that impacts the return metrics. Now we'll just go back to what we had before. So we have the same inputs for the reimbursable expenses and also the non-reimbursable expenses. You can choose occupied or total, and then a growth rate for each line item. Expense type, is it total per year or square foot per year, and then what that stabilized amount is. Rent growth and loss. We have some factors attributed to market rent growth in different years, some for vacancy loss, and then some for other rent loss, just so you can capture any potential loss or underwrite this a bit more conservatively or more aggressively if that's what you'd like. Okay, so then underneath we have the tax section. We built this tax section out to incorporate kind of two methodologies. Obviously, there's a lot of ways and a lot of ways you can kind of back into what potential taxes could be, or you could have actual figures, right? So, the easiest way we built this out is there's this toggle. You can select hard code tax inputs. Here you can choose actually what the annual taxable amount is in each year, and then from year 6 plus, what is that year 5 tax amount growing at. Another way we've done it is by using goal seeks. So this model doesn't have any circular references. It doesn't have any macros. What we do here is we're saying that we're taking X% of either the purchase price or the total investment amount, and that's going to be the taxable amount. And then what we do is you'll see we have a red cell here and then a yellow cell here. We're going to solve what the taxable amount is with a goal seek, just because it's an iterative process. If we're deriving the amount that we're paying in tax, which is based off of the value of the asset, but the value of the asset is based off of capping the NOI, and the NOI needs to factor in a taxable amount on the expenses. So it's circular in that way, but when we can do it with a goal seek, really get around the circularity because it does the iterative calculations for us. So we've kind of outlined how to do just that. You go to the ribbon bar up top, you go to data. So if we click data, you go to what if analysis, we click what if analysis, and then you click goal seek. And then we have some instructions. So A, the set cell field should be set to the red cell on the left. So this is the set cell field. All we do is click the red cell. B, the to value field should be set to 0. So to value should be 0. By changing cell, right? C, by changing cell field should be set to the blue cell on the left. So that if we click that and then click OK, it'll run the iterative calculation. We'll get the right figure. All of this conditional formatting goes away. And now we are figuring out the right amount for the assessed value. And we're taking 1% of that for the taxable amount. Okay, and then the other portion of the operating inputs on the inputs tab is this operating reserves bucket. This is a pretty cool feature. We've built it out so that you can capture in an operating reserve bucket whatever your potential shortfall might be at an operational level. And I'll explain what that means in a second. So if you don't want to build out your reserves, now, by the way, we have like a replacement reserves section. This is more so just on a daily or a monthly basis, sweeping, however much per year, whether it's a total amount or based off of square footage. This operating reserve section is going to be holding back some cash flow so that you can cover some of the more substantial costs like tenant improvements, TIs, or leasing commissions. If you don't want to hold any capital back, we can say that we're going to pay everything with equity. Then you'll see your additional operating shortfall is approximately $380,000. Also, something to note that we don't reserve any more cash than what is required in the future due to shortfall. So this 379 is going to be the most based on your rent rolls and the lease turnover of the leasing commissions and the tenant improvements needed over the life of the hold period. So we can pay it all with equity. We can choose to pay it with just operating cash flows. So in this instance, we can choose what percent of the operating cash flows we're going to sweep to cover the shortfall amount. And you'll notice that even if we want to sweep 20% of the operating cash flows based on the amount of operating cash flows and based on when the shortfalls actually occur, we're still going to be short $235,000. So we can also say we just want to sweep from the refi amount. In this scenario, we're going to be short $112,000 if we're just sweeping from the refi amount. And then ultimately we can say we're going to sweep from the operating cash flow and the refi amount. You'll see we're still short that $112,000. That's because we have a shortfall before we're really generating revenue at a project level. So it doesn't matter where we sweep from. But this is just a cool functionality. You can see what percent of the capital is being swept from each bucket. Okay, so that is the operating input section on the inputs tab. Then let's hop to the rent roll tab. On the rent roll tab, you'll see we have individual tenant assumptions. Each row is its own tenant, and you can load it up accordingly. So the type of tenant, the suite, the square footage, is that tenant currently in place or is that suite vacant? If it's vacant, what is the lease up downtime? What's the lease term? What's the rent per square foot per year? What's the rent growth frequency? Are we growing every 12 months, 24, 36, 60? Is it one-time growth? Is there no growth? When does the first rent bump occur after the acquisition? So from the first escalation thereafter, and then you're growing thereafter, given whatever your rent frequency is. What are the escalations? Is there any free rent? What any are we paying in tenant improvements per square foot? How about vacant leasing commissions? Now, again, this is vacant leasing commissions, right? These are all in place, so we wouldn't necessarily need to pay anything, but you could. Recoveries, how are we recovering the expenses for each tenant? So we can recover based on triple net. What percent are we going to be recovering? And that's per tenant. We can recover based on a base year, let's say 2023. We can recover based off of a gross amount or based off of a fixed amount. And then you can input what that fixed annual recovery is there. So we just allow you a little bit of additional functionality there. Oops, let's hop back over here. And then we have the second generation rent roll. So you can see what the retention ratio is, what that downtime in between leases would look like, and then lease term, current market rent per square foot, the annual growth rate, new free rent versus renewed free rent, new tenant improvements versus renewed tenant improvements, new leasing commissions versus renewed leasing commissions, and then the recovery on the back end there. And then we have third, fourth, fifth, and sixth generation tenants too, if there's a lot of tenant turnover or roll based on a smaller amount of lease or shorter lease terms per tenant. So, all the cash flows are underneath, and we also have a few additional spaces that you can load up. So we can load a total of 35 tenants here, but we can always make that larger if need be. And then underneath, you can see the cash flows as it relates to the first generation lease schedule, the market lease schedule, the free rent, leasing commissions, TIs, occupancy, recoveries, market rent per square foot, and so on. So all of this then flows into the cash flow tab, and you'll see the operating statement over here. We're pulling based off of the cash flows. We'll get into this in a moment. Let's hop back to the inputs tab first. So that just covers the operating input section. Now we'll go down to the financing input section. This is where we are going to talk about the capital stack. So what's pretty neat about the functionality of this model is you can choose whether or not you even want financing. So as you can see, first of all, we have an unlevered level of the project returns and then levered. But let's say you don't have an acquisition loan, you can turn this off, right? You can say we don't have an acquisition loan, it's turned off. We also have a Pref equity / Mezz debt functionality here. You can turn this off as well. And then Perm loans, say you don't want a refi after stabilization, you can turn this off. And now, in essence, you're unlevered and you're levered match. Why? Because at the levered level, we're not factoring in any debt. So let's toggle these all to yes, and we'll quickly run through what this means. So for the acquisition loan, you can choose what the loan to value is, and you can choose what portion of the deal is financed. So is the purchase price, closing costs, acquisition fee, project capex, and working capital all financed? You can toggle yes or no. What's the loan fee? What's the amortization period? Is there any interest only? And then what's the loan type? Is it a fixed or floating loan? If it's fixed, you just plug that in. If it's floating, we're going to be tied to SOFR, and we have a floor and a ceiling, and it's SOFR plus 200 basis points or 2%. And the SOFR curves down here. So in essence, you just paste in from Chatham Financial or any other curve you want to pull from, but we have the downloadable link here. You paste in the future 1 month SOFR curve down below, and then you can update accordingly given, as your project comes time-wise, as your project moves forward and you're no longer using forecasted SOFR information, you have historicals, you can update accordingly. and then the actual, the effective SOFR rate will pull based on if we're capturing the historical or the future. And I'll show you where that happens on the cash flow tab. So then we have the Pref equity section. You can choose, or Mezz debt, as I said before, you can choose what amount we are going to be borrowing from this slug of the capital stack, and then how the upfront fees are going to be paid, if there are any. Are they going to be paid current? Are they going to be accruing? Are there going to be any exit fees? If there's a percent of interest that needs to be paid current, what does that look like? What's your current interest percent? What percent of interest is accruing? And then when you have free cash flow, what percent of that are you using to pay this down, the Pref equity slug? And then at the end of the day, when you're paying this off, is there a minimum equity multiple that you need to hit? So in this scenario, we're saying there's a 1.2 minimum equity multiple. And then at the point of payoff, we need to pay an additional $4,200 to hit that 1.2. So this is the Pref return profile for that investor. You see their distributions are going to be 120K because they're contributing 100K. And then their profit is 20K, and that hits that 1.2. So if we have no minimum equity multiple, you'll see they just have a 12% IRR at that 1.16 equity multiple, and there's no additional payout. Cool. So next, let's go into the perm loan. Again, you can toggle whether or not you want the perm loan to be in place, right? If you're actually buying, renovating, and then selling, you probably won't have permanent financing, so you can toggle that off. But if you do plan on acquiring and then renovating and holding, you'll keep this on. You can choose what the loan to value is. And then we built out a sizing parameter, a few sizing parameters for this perm loan. So you'll see right now we want a 60% loan to value. And we're saying that there's a minimum DSCR of 1.2, and then there's a minimum debt yield of 5%. Also, you can see when we're refining in month 20. We're saying that we're stabilized in month 1. And then we're refining based off of a cap rate rather than a dollar per square foot. And for that cap rate, we're taking the in-place NOI and we're capping it at 6%. If we want, we can do value of at refi based on a dollar amount per square foot. That's how you update it. So now we're saying that given that 60% LTV, we're at a 1.5 DSCR and a 10% debt yield. So if we say that the minimum debt yield is 11%, you'll now see that the debt yield at refi is 11%. This lights up yellow because we can no longer secure that 60% LTV in order to satisfy this 11% minimum debt yield. And the max LTV we can secure is 54.5%. Similarly, let's say we want 70% LTV. And now it says our DSCR at refi is 1.29. So if we say we have a minimum DSCR of 1.3, that DSCR, we don't hit that threshold, that arrow drops down to this 1.3 saying, hey, alert, you weren't at a minimum of 1.3 before. Now you're at 1.3, but your LTV is not, in fact, 70%, it's 69.5%. Similarly, with the perm loan, we are going to say what our loan fee percent is, what the amortized period is there any interest only, and then is it floating or fixed? And then the last portion of this input section is the sensitivity analysis. So we've built out a 2-variable sensitivity analysis. We're sensitizing exit cap and we're sensitizing sale month. So in this section over here, you can see what we're sensitizing. The sensitivity right now is on levered profit, but we can choose profit, equity multiple, IRR on a project level, on a GP level, or on an LP level. So let's say we want to understand what the sensitivity is at a GP profit level, right? And we still want that 12-month spread, that 25 bip spread on the exit cap. We're selling it a 6 cap, and we're selling it in month 120. By the way, if we sell in month 100, you'll see down below, it'll say manually input this to 100. We'll have to do that. And then this yellow bar is showing that we still have some information left to tackle. This is red. It says note if return cell is red, update data tables, go to formulas, calculate now. So we go to formulas up in the ribbon bar, and then we click this calculate now button. It'll iterate. The reason we do this, and this is kind of a big point over here, it's still iterating. Give it a second. Boom, now it's not. But this is a big point. We make sure to run all of our models in automatic except for data table. This is big, big, big. If you run the model in automatic, every time you make an adjustment to one of the blue cells, the input cells, then the sensitivity table will run in the background and that'll slow down the model. So as a result, we keep this automatic except for data tables. And then when we are finished inputting all of our inputs, all we do is we click that calculate now button and the sensitivity analysis will update automatically. So this is how, this shows you what the GP profit will look like given the different sale month at the different cap rate. And we can say what that would look like at a levered project level. And then again, click that calculate now. And it'll iterate. And here we go, right? And you'll see it's actually, you have 3 million profit and then 1.5 and then 3 and then 4 and then 2.5. This is because there's lease turnover. So you just want to make sure you're selling it at the right time. And if you're selling it when you do have vacancies and you're not maximizing your potential revenue, you solve for that in some way, shape, or form. Okay, so next, we already talked about the rent roll tab. Next, we'll talk about the partnership returns tab. This is, actually, we'll get to the partnership returns tab in a minute. Next, we'll talk about the cash flow tab. So the cash flow tab is where all the calculations are housed. And you can see it's separated out into different sections. We have the acquisition sections. We have the operating statement section where we have the revenues on top, and then the operating expenses, and then the NOI, and then the capital costs, and then we have a little reserve section, and then we have the net cash flow. Let me zoom out a little bit. There we go. Then we have the capital stack section. So we have partnership equity over here, GPLP, which we'll get into. We'll break this out even further. Then we have pref equity. Then we have the acquisition loan. Then we have the perm loan. And in this case, the perm loan comes online in month 20 where we're paying off the acquisition loan and anything outstanding with the pref equity if we can afford to pay that off. Then we have the operational reserve section. So this is just kind of where we calculate all the operational reserves. Honestly, we can hide a lot of this. Some of this is illustrative to calculate what the operational reserves would be at an unlevered level. That can definitely be hidden, but the calculations are there. And then to keep it as simple as possible, we can hide this calculation section of the operational reserves. Then we have the sale value section. So in this scenario, we said we're selling in month 100. The sale value is going to pay down the perm loan. And then we break everything out into contributions and distributions. We really say that modeling really only has 3 types of assumptions. It's contributions, distributions, and timing, right? How much are we spending? Contributions, how much are we receiving? Distributions and timing, when does all that happen? So we try to break it out as simple as possible in those terms. Contributions, we've broken it out into initial contributions for the project and the renovation, and then operational shortfall, that gives us the total project cost, the total equity required. And then for the distributions, we have distributions from operations versus distributions from any capital event like refi or disposition. And then all of this information flows into these 2 line items, a net unlevered cash flow line item, and then the net levered cash flow line item. So unlevered, again, is no debt. Levered is debt. So using that levered cash flow, oh, and by the way, we can click this plus button and then we'll just have some additional inputs and assumptions, right? You can just see more information if you want to, if you're adding more line items. And then this is a nice snapshot of the stabilized month versus the sale month level versus $1 per rentable square foot per year level. So then we have this levered cash flow line item. This is at a project level. This flows into our partnership returns tab. Now, the partnership returns tab is a GPLP waterfall structure. So what we're saying is, based on the project return profile, how much are we needing to bring to the table? How much are we ultimately having to distribute to the partners? We're then saying, okay, what % of the capital is the GP bringing versus the LP? What is the distribution? What do the distribution hurdles look like? So we have the option for up to 4 tiers, but you can toggle between no tiers. So the distributions are just pari passu, right? And you'll notice in this scenario with no tiers, it's just a 90-10 split. The LP return metrics as it relates to IRR and equity multiple match the GP return metrics. But then you can choose whether or not there are promotes in place, right? A 10% promote above an 8% hurdle to the LP. then the GP gets an additional 10% on top of their 10% of the remaining pie. So the distributions will be 19% to the GP, 81% to the LP. And you can choose, again, up to 3 hurdles. Compounding frequency and the distribution frequency of the Pref. So are we compounding the Pref annually, monthly, or is there no compounding? All this will determine ultimately the amount that the LP will receive based on the Pref percentage. And then same thing with the distribution frequency. When are we making distributions to the LP? Are they going to be annually? Are they going to be quarterly? Or are they going to be monthly? And then we can choose when we're collecting the equity. Are we going to collect the equity all up front, right, at time 0? Or are we saying, hey, we're just going to collect the equity from our partners whenever we need equity at a project level? So everything flows accordingly. In this case, let's say we're going to collect it when we need it. Then we have the annual cash flow amount snapshot. So this is just like the monthly cash flow snapshot, that CF tab, but this is rolled up into a yearly snapshot. So this is annually. We do have this tab that showcases the loan amortization schedule, so you can see what it looks like for the acquisition loan versus the perm loan. And then this is the effective SOFR curve that we're using. And then all of this we like to package and snapshot into what we call our investor summary tab. So the investor summary tab is, as I said, a nice snapshot to share with investors. You can see, you can print it as such, and it'll go into a nice PDF of 3 pages. It's got basic investment description, snapshot at different times, stabilization versus refi versus sale. You can see all this will update automatically, right, in terms of timing. The deal notes, we have generic deal notes on the project. The deal notes will update automatically. These are all formulaic. We have basic investment descriptions as it relates to unlevered project returns, levered, Pref equity, LP equity, GP equity. If for some reason you don't want to show the GP returns, you can say no. If you don't want to show the LP returns, you can say no. And then you just have Pref, levered, unlevered. We have sources and uses. This is all dynamic and auto-populates accordingly. Same thing with the charts and the graphs, and then more notes for the acquisition loan versus the perm loan. We have the sensitivity snapshot transposed onto the investor summary tab from the inputs tab. We have the operating statement. We have current in-place rents versus market rents. You can toggle between rent per month, rent per year, rent per square foot per year, right? And this will all update automatically. Then we have underneath a snapshot at stabilization. So in this scenario, we're saying that's month 1 versus a snapshot at sale. What do the operations look like in these different time periods? And you can see what the valuation at stabilization is. We're using a 6 cap. Valuation at sale, we're using a 6 cap. And at stabilization, we're saying we're taking the in-place NOI, whereas at sale, we're taking the forward 12 NOI. And then we have a brief annual summary, which again, it's very similar to the annual cash flow tab, but this is even less information, but it's clean, concise, and straightforward. And then underneath, we have more partnership equity, Pref equity. You can expand this if you'd like. Acquisition loan, perm loan, similar segments as we had on the cash flow tab and the annual cash flow tab. And then ultimately we come down to this partnership split section. We can hide that if we want. So we just end in unlevered and levered cash flow at a project level. But if you do want to showcase the partnership level return, you see what the LP is contributing and getting in distributions, and similarly what the GP is. And then the second to last tab, I should say, is the lender summary tab. So very similar to the investor summary tab, but this is more so from a lender's perspective. It doesn't have as much information, and we try to break it out based off of the debt request, right? So the debt request of the acquisition loan is $900,000. It's SOFR plus 200, 50% LTV with 1% fee. And then what the lender's contributing, what their distributions are, what their profit is. And ultimately, when we're exiting out of that acquisition loan, what is the NOI at exit? And we're taking the in-place, proceeds at exit, proceeds multiple, DSCR at exit, debt yield, right? And then similarly, we have a property snapshot at month 20. And then if that lender does want to potentially do the refi as well, we showcase what that might look like. Operating statement, sources and uses, graphs, charts, and just regular figures down below. And then finally, we have our disclaimer tab, which just kind of outlines what the model can and can't do, and how, if you get a heart attack from looking at the numbers, we're not liable. Whether it's a good heart attack or a bad heart attack, but I guess in essence, either would be great. So this is our commercial acquisitions model, our premium commercial acquisitions model. Pretty straightforward. Please feel free to reach out if you have any questions, and we're more than happy to give you a personalized walkthrough. And with all of our models, as I said, we have these templates, but we also customize them given your specific deal scenario and criteria. So with that, if you have any questions, please reach out. And yeah, really appreciate your time walking through this model with me, and have a great rest of your day. Again, my name's Spencer Crenti with Alkaline Advisors, and we're at almost 30 minutes on the dot. So have a good one.